Where the hell?
The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. We'll be with you in about 30 seconds. There's just a few more people logging on here. Okay, hello everyone. We appreciate you being with us this afternoon or this morning, depending on where you're calling in from. My name is Joe Corio. I'm Senior Vice President of URL Insurance Group, and I'd like to thank everybody for all the business that you write through URL. Whether it's annuity business, single premium life, traditional life, health, group, or Medicare, we truly appreciate your business. We know that you have choices as to where you can place your business, and we're glad that you have chosen URL to work with. I'd also like to congratulate everybody on being on the first of our Department of Labor Update Webinars, which is being brought to you for your own knowledge and information. As you know, URL is a full-service broker. However, we are not trying to push products on this webinar. We're not trying to push services on this webinar. We're just trying to provide you, the annuity producer, with the information you need on a subject that will dramatically change the way you do annuity business starting in April of 2017. I just wanted to start by saying that by no means am I an expert on the DOL rule. And I don't believe anyone else in this industry is an expert either. Yes, there are those that may know some aspects of the rule a little better than others. However, there are no experts that have all the answers. It's brand new territory for everyone, which includes agents, marketing companies, home offices, and broker-dealers. It's impossible to believe that anyone is an expert on this subject, considering the fact that all the guidelines regarding the rule have not been handed out by the Department of Labor yet. And it's funny, every day I receive emails from our competitors and they tout being able to have all the solutions for your problems. They understand the rule and they have the options for producers, et cetera, et cetera. This kind of makes me laugh. It's hard to believe, considering the department has not released all the information yet, nor have they clarified all the points that they did release, that they have all the solutions. With that in mind, our intention on these webinars is not to tell you we have all the answers and solutions to your problems. I can tell you that we understand how the DOL rule will change the way you do annuity business in the future, and it will tell you that we will have outlets for your business. However, I openly admit that we are not sure what exact path we'll be taking to help you be productive in 2017 and beyond. We are working on numerous options, and we will have the answers for you soon, but we do not have a confirmed place in plan right now. In the past, URL has given guidance to agents in regards to other industry roadblocks that have come up over the years. The most recent is the Affordable Care Act, and we've done that by providing informative webinars designed to give you, the producer, the information you need to make the critical decisions that are best for your business model. We will do the same as we navigate through the DOL rule in the months ahead, and we will be here to assist you when the new rule takes effect. For your convenience, we have set up a system in which, by being on today's webinar or listening to a recorded version of today's webinar, you will automatically be scheduled to receive a recorded version of all our DOL Update webinars, should you not sit in on the live broadcast. Also, today's webinar is an interactive broadcast, meaning you can ask questions, which we will answer towards the end. And the way you can ask questions, if you look on your screen in the little box, there should be an area where there says questions, and you can type in any questions you want. We'll pull them up at the end and try to answer them the best as we can. Okay, with that in mind, we're going to start with a little history. What is the DOL rule? The DOL Fiduciary Rule started to get its life just about 5 years ago when it was introduced by the Department of Labor. Unfortunately, or fortunately for us, it was withdrawn very shortly after its introduction due to the financial industry's fierce protest to the proposal. It wasn't until early last year that the momentum for the rule really started to gain steam. In February of 2015, during a speech given to AARP in Washington, President Obama directed the Department of Labor to move ahead with a plan to revise the fiduciary rule. Mr. Obama said that there are many financial advisors who receive, quote, backdoor payments or hidden fees for steering people into bad retirement investments that have high fees and low returns, thus reducing their retirement nest egg. This rule was designed to require more brokers to abide by a fiduciary standard and put the best interest of their clients above their own when providing advice on retirement savings. So after going back and forth within the department, there was a lot of news briefs, there was an open comment period and so forth. After 14 months, the final version of the DOL rule was announced in April of 2016. Fixed indexed annuities as they pertain to qualified business was included in the final version. And this was a surprise to many industry experts because when they proposed the rule originally, fixed index annuities were not included. But when the final rule came out in April, they were included. So the new rule references many things in regards to how financial professionals are compensated. Many of the rule opponents say the department is trying to force everyone, meaning agents, brokers, dealers, and advisors, into a fee-based system by having a financial professional become more intent on acting in a fiduciary manner. The fact is, this rule is not about compensation. Trust me on that. It is about acting in a client's best interest. I know the vast majority of you on today's call are probably thinking to yourself, as I was when I first heard the rule, I always act in my client's best interest. Well, of course we do. Why most of us do that, the new rule now makes it your legal obligation to do so. So, as we speak today, the rule is in place, and all agents, broker-dealers giving investment advice must comply with the rule starting next year. Selling fixed index annuities as we do today will soon be changing dramatically. Okay. Now, I should mention there are a few lawsuits out there that are pending. I believe there's 4 left. The National Association of Fixed Annuities already had a court hearing, and they have recently been informed, I believe it was yesterday, that they have lost that case, and the DOL has been upheld. However, NAFA has vowed to appeal that decision to the next highest court. So we'll see where these go. So let's talk a little bit about what changes will specifically occur with the DOL. For agents who sell annuities, there will be many changes, but I'm just going to highlight a few of the most significant ones here today. First, the new DOL rule will be phased in over the next 14 months or so, with the first compliance phase taking place on April 10th of 2017. Full compliance is required by January 1 of 2018. So we have about 5 months to get ready for this rule. By the first compliance date of April 2017, retirement investment advisors, which includes brokers, dealers, and insurance agents, are required to abide by a fiduciary standard with clients that have IRA accounts. A fiduciary standard means delivering advice to investors under a best interest standard instead of the traditional suitability standard that we're all kind of used to. In simple terms, the insurance agents are required to do some of the following things. They're required and obligated by law to act in a client's best interest by eliminating any potential conflicts of interest. They're required to avoid misleading statements, and they're required to provide advice and product recommendations with detailed documentation, and that's going to be important going ahead. And in the case of fixed index annuities, you need to get signed approval by a financial institution and the investor. We'll talk a little bit about that in detail in just a minute here. There are many other requirements that the insurance agent will have to furnish to the investor as well, and we'll detail all these as we go a little further in our training program. And again, this is the first of many trainings. We're going to do it every other Tuesday at 2 o'clock. To try to keep you up to speed. Some of the webinars we do going forward on the DOL update will only last 10 minutes or so. Some might last 20 or 30 minutes, but we're trying to cover all the areas so that you are ready. Okay, the department has granted 2 exceptions that permit insurance agents and other advisors to receive compensation in the form of commissions when they provide investment advice on qualified annuities. And that's important to keep in track. This is only in regards to qualified business. However, in our industry, about 70% of all the annuity business written is qualified business. So it's going to be a large chunk of your business. The first exception that says you can receive compensation in the form of commission is called PTE 8424. And PTE stands for Prohibited Transaction Exemption, PTE. The second exemption is known as the BIC. So let's cover these 2 areas here. The first, the PTE 8424, this is available for fixed rate annuity contracts. And the Department of Labor has determined that fixed rate annuity products are traditional fixed annuities, multi-year annuities, and single premium immediate annuities. You can receive a commission on these as an agent for qualified business, and sales of them, but sales of those are still subject to the best interest standards that the department has laid out. Okay, so in other words, if you're doing qualified business and you're using fixed products, you are exempt from the rule, with the exception that you still must act in the best interest of the client. You can't be thinking about what's best for me, what one will get me to a trip, what one will get me a higher commission. Those things can't be taken into consideration. You have to be acting in the best interest of your client. The second exemption is the BIC exemption, and that's available for fixed indexed annuities and variable annuity contracts. BIC, or BICE, stands for Best Interest Contract Exemption. This is a process where you enter into a contract with a client that states you will work with them in their best interest. So let's talk about how this will work. There are numerous questions on how everything will work exactly. However, carriers are still working very hard to develop a plan or plan of action to continue to offer products that will continue to be in the best interest of clients while offering them safety of principal and the ability to have a guaranteed income for life. What the products will look like and what the compensation structure will be is not known at this time. There's an awful lot of work that the home offices have to do to comply with these rules. We do know this. For the BIC exemption, agents will need to work through a financial institution. Now, a financial institution is one that meets the guidelines set out by the DOL. And by the way, these guidelines have not even been specified by the DOL yet, as of today. A financial institution can be an insurance company, it can be a broker-dealer, it can be a bank, or it can be an FMO, such as URL. When an agent engages in a working relationship with the client, they will have to have what is called a BIC signed. a BIC, or again, the best interest contract exemption. This will have to be signed in order for you to propose an indexed annuity that pays a commission if you're dealing with qualified funds. The BIC is not signed by the agent. It's signed by the client, and it's signed by the financial institution. The client's signature on the BIC indicates that they feel you are acting in the best interest. The financial institution's signature indicates they're basically vouching for you. As the writing agent, they're saying that they feel you have acted in the best interest of the client and that you followed all the guidelines laid out by the DOL. The financial institution will really have the requirement of overseeing your business, and they will be responsible, along with you, for your actions. Agents that are security licensed can have the BIC signed by a registered investment advisor, or they can have a broker-dealer sign it. For insurance-only agents, which most of you out there probably are, a financial institution such as an FMO like URL or even a carrier will have to sign off for you. At this point, a few insurance carriers have committed to signing the BIC. In other words, they told the DOL that we will be responsible for all the agents who write fixed index annuities on qualified business. Only a few have signed this at this point. In addition, there are about 18 FMOs that have requested financial institute status from the Department of Labor. Again, they've only applied for it. They don't even know what the requirements are, but we've applied for it. When these requests will be acted upon is anybody's guess at this time. Just a quick side note here. You know, there's a lot of marketing companies out there that are posting, I see emails every day that say they will be a financial institution and you should work with them. You know, yes, they might have applied for a financial institution status, but the guidelines to become a financial institution have not even been published by the Department of Labor yet. So how do they really know that there'll be a financial institution? You know, when those guidelines come out, they might say, you know, it's not worth it. Maybe you have to have too much capital or too much overseeing of the agents. I don't know. Nobody knows yet. So just because they applied for it doesn't mean they're really going to be a financial institution. So beware of what you read in the form of email advertising. Okay, before we wrap up today, and before we wrap up, we're going to ask questions. But before that, I just want to mention briefly about the licensing requirements for those that want to sell indexed annuities post the DOL rule. I get the question a lot, will I need a security license to sell indexed annuities next year? Well, simply put, the answer to that question is no. You won't need a securities license to sell indexed annuities next year. However, I should elaborate a little bit more on that. The Department of Labor rule does not ban the sale of commission-based investments. However, as I mentioned earlier in the broadcast, the majority of the industry's analysis has said the rule's design strongly favors fee-based compensation. The feeling is that fee-based compensation will help eliminate the potential of any conflict of interest when you're helping an investor find the right product or investment for them. So you can still sell index products without a securities license. However, when recommending fixed indexed annuities, you will have to comply with the rule of the best interest contract exemption, as we just spoke about. If you're selling commission products versus fee-based compensation, it really leaves the door open for questions to be asked, such as, did the agent act in the best interest of the client? It also raises the question, if you're not talking to clients about products other than fixed indexed annuities, are you acting in their best interest? It is commonly felt that if you're selling only commission products and you're selling the same product, let's say, to every client, then really, are you acting in the client's best interest? Is everybody the same? This is a decision you'll have to make. So we plan on having some training and guidance in this area as we get closer to rule implementation. So really, real quick, as far as the licenses, what I wanted to do is just summarize what's out there in case you decided you do want to go that way after a while. I wouldn't jump into it, but in regards to using a fee-based compensation arrangement, let's quickly review the different types of licenses that are available and what they'll allow you to do. And keep in mind, the licenses I show here and I mention are not the only licenses that are available, but these will be the key licenses you need to be aware of in regards to the upcoming DOL rule. First, the Series 6. That license allows its holders to sell packaged investment products such as mutual funds and variable annuities. The Series 63 license, which is known as the Uniform Securities Agent license, this license is required by each state, and it authorizes the holder to transact business within that state, so you'll need that. Next is the Series 65 license. This license is required by anyone intending to provide any kind of financial advice or service on a non-commission basis. So this will allow you to charge an hourly fee or a flat fee percentage of assets for the services. Last, the Series 7 license authorizes holders to sell virtually any type of individual security, which includes common and preferred stock, call and put options, bonds, and so forth. So we're going to talk more in regards to the Series 63 license in our next webinar. However, that is a license you should consider if you plan on doing fee-based services. In fact, we hope to be announcing on the next webinar a plan to assist you in getting that license in a very streamlined fashion should you care to do so. Again, tune in for that one on our next webinar, which is to be held 2 weeks on Tuesday at 2. So let's, before we cut off here, let's just go and see if there are any questions that might be had. Do we know what the timeline is for the DOL to clarify some points? No, the DOL has said that they are going to clarify the points in the rule in 3 stages. So far they have issued the first stage, which has come out, and that's the one that they said clearly you don't need a security license to act in the DOL. There's still 2 more rules, 2 more clarifications that are going to come out, but they did not indicate when. In regards to the pending litigation, yeah, there's 1 case going on that is completed, but we have not heard the outcome. 1 has been completed and we heard the outcome and they upheld the rule. And I believe there's at least 2, maybe 3 more that are scheduled for later in November. I'm not sure these lawsuits are going to change things much. You know, we're so far down the road here that every day that it takes to get a decision, even if it was in favor of anti-DOL, I think we're just too far down the road. And I can tell you, I still think, regardless of what happens, there's going to be a push to act in the best interest of the client going forward. So we'll see what happens there. Let's see if there's any other questions here. No, I do not see any other questions. So with that, okay, this does it for this segment of the DOL update. There's still a lot of information to talk about in regards to the rule. So I would just like to remind you that we will be doing these every other Tuesday. And since you are in this webinar today and you're enrolled in our webinars for the future, so you don't have to sign up, we'd love to have you tune in if you want to do the live one, sign up. If not, you'll get the recording. If there's any other questions, you can contact me in the meantime, and I'll be glad to talk to you. But we're going to do our best to give you all the information that we need through these webinars. So with that, I'm going to say thank you for attending. We wish you the best of luck, and remember, we still got 5 months to wrap up. Have a great end of 2016 and the beginning of 17 under the current rules. It's business as usual. So I appreciate everybody today, and thank you, and have a great day.